This year so far, have you had a lot of clients reach out that have checked on their loans and ask you guys about loan maturities or any refinancing options?
Several. So kind of the challenge with it is, one, understanding when's the maturity and then what state is the asset in, what's the cash flow look like today? Are we coming out of bridge? What are we exiting?
Sure.
So there's always different things we have to kind of nail down. I'm sure you get the same kind of calls. And then in fact, I think we're working on a deal together where, we've got a client, he's looking at both options, whether refi to stay in the deal or sell. And the challenge there is timing.
Right.
So timing is everything, and it's hard to kind of predict what the debt markets are going to look like in a year from now, a week from now, whatever that may be. So, ideally, what are we talking? I mean, a year out is when you'd like to know. Conversations with someone like you or me, one, BOV from you is critical.
Yeah. I mean, I think in a perfect world, we'd meet with our clients on an annual basis and just understand that maturity date as it's coming up 3 to 1 years out. And we've got a plan long before they ever come up on it. Whether we're connecting them with you and you guys are looking at refinancing and it's a long-term hold and we're just strategizing into the future, or we're just sort of prepping the sale early on. I think, you're 3-4 years out, maybe it's hey, your loan's still assumable, you've got a little bit of a commodity to sell here. Maybe this is a good time, or if you do want to hold, let's start planning for, what the next steps are.
Yeah. A lot of clients haven't transacted in the last 3 to 4 years.
Yep.
And as you know, and I'm sure a lot of folks know, the market's considerably different than it was in 21, 22.
Yeah.
And, that's because the debt markets have changed. So the lens that potential buyers are looking at deals through is different than what they were 3 or 4 years ago, and kind of set that expectation early on where it's a year out rather than we got to do something in 3 months, whether it's a refi or, a sale. They need to have a good idea of what their property is probably going to be worth, what the debt looks like. And it's not what it was 2 or 3 years ago. And that's been a challenge for us personally is, cash flow looks good. They've executed their business plan. They had 10 years. They're kind of shocked when your value's actually gone down a little bit because cap rates have changed based on the debt markets and what's been happening. So
yeah, I think it's interesting. There's been certainly some cap rate expansion over time as the markets have tightened financially and as it's just kind of opened up. And the other thing that is a major change from several years ago is you might have bought on pro forma, met that pro forma, and now you want to sell on the next person's pro forma, but nobody's buying on pro forma anymore. You're buying on as is, so you're going to sell at the same value that you were at, but cap rates have expanded. So maybe your property value went down.
One thing that we can do is, so if that's the scenario, what's important is, okay, I sat down with Quinn. I have an idea of what, we're going to stay in this deal for another 2 years because we're hoping that cap rates compress a little bit again. We're going to get that value we thought we were going to get on this exit. And we're just trying to buy a little bit of time. So then it becomes important, well, how do we want to structure that financing? Because there's a variety of different platforms that they can run through. Your traditional agency deals, they're going to have a step down or yield maintenance prepay, 5-year minimum on the term length, and there's different ways you can structure that prepay. There's a price to pay for it, but then there's other avenues outside of agency where, 2 or 3 year note, your rate may be is going to be higher than agency, but your exit's going to be 0. So now, it's kind of running the numbers. What's my cost of capital staying in this deal? And then really making sure we outline base outcome in 2 years, good outcome and great outcome, or bad outcome. You really want to make sure you're mitigating all those scenarios because, as people are finding out now, it doesn't always look as rosy. You weren't able to execute the first go around. Why are we going to extend this out for you? That's kind of the challenge. That's one of the newer challenges we've been facing with more of our deals than we had in the past.
Sure. And are people still trying to take out the same amount of leverage they were on the first bridge, carry it into the next, or are they bringing in more equity and trying to recapitalize it all?
Great question. It really, as you know, and everybody else, it's, well, what's the property doing today? What's the current cash flow?
Yeah. Sure.
Ideally, you'd like a cash neutral transaction on the refi if you're just going bridge to bridge.
Yeah.
But we're having some folks that, whether they're syndicators and they got to raise a little bit, that dilutes the returns for some of their investors. So, those are some hard conversations I know are happening, but, traditionally, I try to, I want to tell them, yeah, we're going to do a cash neutral refi, but really the numbers tell the story. And there's not a silver bullet for every deal.
Yeah.
And that's kind of the challenge we face is, oh, we've got all these different platforms to work through. I need, I need this leverage, I need this rate, I need this, structure. And really you're going to have to give up on one of those levers to get, hey, if proceeds are most important, you're probably going to pay a premium on that rate.
Yeah. You feel like when you look, client calls, I've got a maturity coming up, I'm trying to refi because I want to stick in this deal, or at least I want to start with that. How many typical lenders do you think you go through as you're?
Typically we have 10 to 15 lenders that we know like certain types of deals, and that's our first wave once we've got our full package together. And then, if we're not kind of getting where we need to, we can go, we've done some deals, we go out to more than 100 lenders. Now that doesn't mean we're going to get a term sheet from all of them.
Yeah.
But we're just basically, we're putting it out there. And like I said, the first phase, very focused. Okay, we transacted with these groups on a number of deals. We know what they can and can't do. We know when they proffer and, kind of the initial term sheet, they're going to stick to those terms rather than getting retraded. And then, if we're just not getting to where the client needs it to be, then obviously we go out, we vet other lenders that we've worked with, and we look for that silver bullet. We try to avoid it though, because, time kills deals, and that for the client and for us, the longer they sit on it, the closer we're getting to that maturity date, the probability of executing on a level that's reasonable becomes a lot slimmer.
Yeah. Goal is to pull out more capital or leverage more capital into a next phase of the plan. Maybe it's you're building something else, or you're doing another phase of remodels, or whatever it may be. There's a big CapEx spend, roofs, whatever.
They're focused on stuff that's a little more put together. So it's extremely important for me to have the full picture together before I take it to lenders. If you're wanting term sheets that are going to be pretty on the money, that are going to be vetted by some members of credit before they even give me a quote to send over to the client. So, what it does is it eliminates any of the guesswork. It speeds up the process.
Does the schedule of real estate owned also help you look at maybe other assets that you might be able to leverage to pull capital into it?
100%. So certain pressures that make it a little more difficult for a lender to feel comfortable. And in order to mitigate that perceived risk, or that risk that they see, is, hey, you've got this little, let's call it a fourplex over here. What's the debt look like? And understanding that scheduled real estate, the reason it's important is, you're going to have your estimated value of that property, your current debt. And if there's no leverage on that deal, they may say, let's collateralize that too. And that mitigates it, and that's going to help the pricing. It can help structure. It gives you a little more negotiating power with the lender. I always say there's need to haves and nice to haves. If you want to have the nice to haves, you have to be willing to give up some stuff. And that's one way to do it. I mean, every scenario is different, and get to the need to haves first, and then we can work out on the nice to haves once we've got a full picture. But I can't do that if all I know is here's T12 and here's the rent roll. We're running in the park.
Yeah.
So it's extremely important for me to understand the borrower's profile.
We're trying to provide as much value as possible, and ultimately the more information you can share with me and the more you can help me understand your full situation, the more I can sink into it and actually provide value.
Narrow hallway you're walking down there, but if we can get a full picture here, it could potentially open other doors, or now I have different lending platforms I could go through, because I know this lender over here likes these types of deals, but you know what, the cash flow is not great here, but if we can collateralize this stabilized property here that you don't have any debt on, or maybe you have some debt, but they have a more competitive program than what your current note holder has, you find that sometimes you can uncover a gem there.
Yeah.
And the client walks away like, oh, I was expecting this and I got this and this, whether it's a better rate on this deal. I wouldn't say right now we're seeing a lot of better rates on conventional refis. It's more of...
You can't give me a 2% loan anymore?
I haven't seen one in a while. Although, Freddie, Fannie small balance dropped 25 bips last week, which is the first time I've seen that in a while. So that was a pleasant surprise.
Step one, call Quinn and Max on a conference call, and they're going to tell me I need to send them my T12 and rent roll. Next step, define my business goals from here. What have I done so far? What am I trying to do next? If it's next phase of business plan, you're looking at bridge, maybe. Goal is to sell, and they're just trying to get past this maturity phase so that they're not on a ticking time bomb. Then maybe it's just like, what's the best interest rate we can do with no prepayment penalty? Let's understand what the financing options are. while also looking at what buyers are looking at in the market, because they're going to be a little different, right? Like when I'm looking at buyers, it's kind of like, what's the top end of what we think buyers are going to do? Looking at this, who's active in the market, who can I call and kind of get feedback on? And I think your numbers are probably a little bit more strict or conservative, particularly in this market. What do you think are the biggest differences between the way you look at an asset to take to the banks and that I look at an asset to take to buyers when somebody first comes and starts talking to us?
I mean, the numbers don't lie. I underwrite the deal, I'll put in market rates, I'll run it through different models that we have just to kind of understand it. Execution type is going to look different on a purchase. If we're having this meeting a year out from a maturity, I think it's huge, because what we can do is I'll line up debt options. This is what it looks like if someone was to execute today. And the client will tell you, Quinn, this is how much I need to sell it for. This is my goal. Let's look, and if there's a shortcoming on, like if I'm only getting like 60, 65% LTV on a conventional type financing, then it's like, okay, well, how can we boost the NOI? Or
we can help you position that and put it in front of the right people quick. But it's always a balance. And so, that goes kind of back to what's your game plan, what's your strategy, and do you need to move this quick? And do we need to price it like you're trying to move it quick? And it's not like we're going to go to the market and say, hey, this is a fire sale, come buy it. But is that the pricing strategy, or is the pricing strategy put it at the top and stretch for who's going to get there?
More science, I think, when you're looking at the debt, it's very numbers oriented. The debt's the debt. What lenders are willing to give you is what they're willing to give you. Like you said, there's unique buyers that have unique assets they're looking for, unique business models that do fit at understanding, hey, this is what I need to get, and being able to have time to implement a plan to get to that valuation that they want. If you're doing it a year out in advance, listing the deal, you know what they want to sell it for, you can tell them, hey, if you want to sell it for that, that's great. What can help is if you can do X, Y, and Z in the next 6 months. Insurance, that's what's been, from the debt side, that's been killing deals, right? Because insurance rates have just skyrocketed. Insurance is coming up yearly, is to reassess that. Make sure you're talking to the right folks. It's not an area of expertise for me. Worked with a few folks that do insurance, and they've been deal savers. And it's important because that client always worked with their State Farm person. Nothing wrong with that. But sometimes they don't have the markets available that these other groups do. Insurance has been a big kicker on just the refis. It's and then you get clients that finance the deal for them on the front end. The lender required insurance coverage isn't the same as what some of these more institutional type lenders have, and that's kind of a little bit of sticker shock for them when it's like, okay, here's where we're at on this. If you want to refi out, here's your 30-year AM. This is not recourse. But your insurance requirements are going to change. Usually the one thing I try to prep clients for well in advance of even transacting is let's look at your insurance real quick. What are you paying? What's the coverage look like? And once again, that's where, it's not my area of expertise, but I know that that's extremely important. Like understanding insurance policies and what coverages are required, this and that. We've been able to finesse a little bit of it, but it requires bringing in that broker. Exactly what the lender's looking for.
Right, the guys that work in that business are great. Bring them along to help solve that problem and bring value.